All right, we got a few stragglers, but Al, you want to go ahead and kick things off?
Yeah, maybe just give it another couple seconds. Andrew, let everyone get in here. All right, I'll go ahead and get started. Everyone can catch. I want to welcome everybody. My name is Al Danto. I'm the managing partner of Exit Advisors. I'm also on faculty at Rice University. I teach entrepreneurship, business acquisition, and classes on business valuations. So Exit Advisors is a small, but I think very experienced, powerful M&A, mergers and acquisition firm. We mostly focus on advising small business owners of exit strategies, both short-term, unexpected strategies, and long-term. We also do business valuations. We're going to be joined today by Trevor Shakiba from Shakiba Capital. Very excited to have Trevor on board. Our whole town hall series started when the pandemic kind of commenced, and it really went from fear and hunkering down and defensive strategies. We talked a lot about PPP. How do we get through this? How do we furlough and everything? And we're getting to a point where we're really excited about being entrepreneurs and working with small business owners and investors. Is how do we switch from defense to offense? So that's what today's all about. Case, you want to go ahead and switch slides. This topic started with a conversation. We had a client that reached out from us, someone that I sat on a board with through Rice, and he said, I want to value my business. We used some of our retirement money when we started our company, and we want to convert to a Roth IRA. Well, valuations are down. We think taxes are at an all-time low. We want to convert now, so that way all of our future cash flow streams will be tax-free. As experienced as I am in this area, as much as I should have known that, I did not realize that once you converted to a Roth IRA, that all future dividends and cash that came from that was tax-free. And they're going to have some pretty substantial dividends that are thrown off of this investment that they have, but the valuation's down. So I reached out to Gary Cooper, my partner, a CPA, and I said, is it true, Gary, once you convert to a Roth IRA that all these future tax streams, cash flow streams are tax-free? And he says, they are. So we came up with the idea to say, what other opportunities are out there? Being kind of a valuation expert, if you think about the public markets being down over 20%, large caps being down 20%, I believe the Russell 2000 is down almost 30%, then private companies right now are down even more than that. They're riskier than the general market, so they're down even more. This can change in 60 days, 90 days, 120 days as we go out, but at this point in time right now, private valuations are down just like the rest of the market is. So, what strategies can come out of that for small business owners? Well, there's long-term tax strategies that can come out of there. We can seek as investors to acquire assets, maybe in real estate, other areas where asset values are down, convert to a Roth. We can gift shares now. We can give away equity compensation. All of these can be taxed, but if we think about taxes being down, interest rates being down, valuations being down, what can we do to take advantage of that right now? What can we do to take advantage of this opportunity? Trevor came up with a great quote. I'll paraphrase it, but it came from Warren Buffett and said that every few decades, the skies of gloom reign in the investment world, and it rains gold. And I was really caught by that, and I think it's true. I think there's a lot of opportunities. You have to be exposed to them, you have to understand them, and you have to talk to experts that really can pull this together. So we're going to talk about a lot of these strategies. But talk to your CPA, your financial planner, your estate planner, legal counsel, insurance, and other advisors. So now I'm going to turn this over to Trevor Shakiba. Trevor is a true professional. I think he shares our value of education and knowledge. He's willing to share his time and experience. He built up a incredible practice, financial planning firm that he built up. He sold it last year in October. Perfect timing, Trevor. I'm sure you knew exactly what was going to happen and you got out at the right time. But he sold it. It was the largest practice sale in Ameriprise history. He wanted to focus on his family, real estate opportunities. He formed a foundation at Shakiba Capital. Trevor lives in Houston with his 2 children, Tobias and Maya. And if you haven't caught Trevor on Houston Life, he's on every Friday. So Trevor, welcome. We appreciate your time. We appreciate your knowledge. And I'm going to turn it over to you right now. Thank you.
Yeah. Thank you, Al. Nothing I would rather do than talk about the economy and capital markets. So when the invite came, I thought, man, what an honor. So thanks so much for the invite. I'm going to jump to the next slide, Casey. Before I jump in, I've got 5 tips from the very simple to maybe a little bit more advanced that I want to just put out there to everybody. But before I do that, I think it's important to set the stage when it comes to what happened, because this is unprecedented when it comes to the uncertainty that we saw that started February 12th and the volatility that followed thereafter. There's that quote that Al mentioned, and I think it's so appropriate, even though that's from his annual report in 2016. We will look back on this, because this too shall pass, sorry. We will look back on this as a phenomenal opportunity, maybe a once in a decade opportunity. So how do you take advantage of it? So the first thing I want to point out is this, we actually saw the quickest correction ever. And a correction is defined by a 10% pullback or more in the capital markets. That actually happened in 6 days. And you can see on February 12th, everything's rolling along great. The Dow was at 29,500, pushing 30,000. And literally 35, 40 days later, you can see the Dow was around 18,000, 35% approximately. So the volatility was just simply stunning. A measurement that I look at a lot is the VIX, just to give you another perspective. That measures volatility. That was the highest it's ever been as well, higher than 2008 and 09, when our financial system was really on the brink of collapse. So with volatility and uncertainty comes opportunity. That's what we're going to talk about is how can you position yourself to take advantage of it. And the question, I put that at the bottom, the question in my opinion, which frankly, I don't think anyone knows the answer to, is when does demand return? How quickly and in what areas? And it may even be a state specific type of situation. So next slide, that sets the stage. Maybe the most important thing I can put out there is that don't forget about the fundamentals. This is often overlooked when it comes to investing. But remember what you're doing when you're talking about investing or building wealth. First and foremost, it kind of goes without saying, it's about capital preservation. And what I mean by that is everyone wants to hit the home run and talk about how they bought Apple, when it was $3. Those are great, but the truth is that if you could find an investment that would return passively 8%, everybody would give each other high fives because it would build in an incredible amount of wealth. Another Buffett quote right below that, which always makes me smile, is that the first rule of investing is to never lose money. Second rule is C rule number 1. With that being said, what I found in my career in working with a lot of small business owners and a lot of individuals and helping them plan for financial goals, retirement, some of the most precious things that they had out there, is the biggest roadblock for them was emotion. And I really believe this. Emotion is the biggest determining factor in how successful you're going to be long term. This is like clockwork. And I saw it with clients over the last 15, 16 years, is February. If you go back February of this year, everybody is optimistic, excited, maybe even tending towards greed. And 35, 40 days later, it's doom and gloom into the world. And everybody's doing the exact opposite of what they should be doing, which is, of course, buying low, selling high. The most powerful illustration I can give you is a 30-year study. I quote it all the time, but if you were to take any 30-year period in the market, so 1960 to 1990, for example, or any other 30-year period, the market represented by the S&P 500 or the Dow, however you want to look at it, returned approximately 9 to 10%, annualized, compounded, and which is fantastic. Completely passive investing. If you invested money in the S&P 500 index, took a nap for 30 years, historically you would have seen 9, 10, even 11%. If you compare that to the individual investor in those same timeframes, typically the individual investor is around 4%. And the question is why? The answer is emotion, people letting emotion affect their investment decisions. And again, I saw it all the time. When you should be investing and getting more aggressive, you're doing the exact opposite. So look, start with the basics. Everyone can do this. Just keep doing what you're doing. So for everyone on the call that has a profit sharing account, 401k, IRAs, just because the market's down and volatile does not mean if you have a consistent and good cash flow that you should stop saving in. And the power, you've probably heard this term before, dollar cost averaging, simply means you invest the same amount every pay period or every first of the month. And as the market goes up, you're buying less shares. And as it goes down, you're buying more. And over time, that spreads your risk out. And I used to remember clients would tell me in volatile periods with their 401k, like I added money, my company matched, and my balance was still lower. I'm not going to do this anymore. Well, that's the exact opposite of how you should be thinking, because the market is on sale. Obviously, a month ago it was really on sale, but it is still on sale now. Second piece of advice that I think is very easy is rebalancing. So if you had accounts, as an example, that were 50-50, 50% equities, and then a 50% bonds and cash, now would be a time that you should consider rebalancing and maybe going 70% equities and 30% bonds cash. Now there's a lot more to it. You got to look at your risk tolerance, time frame, what you're trying to achieve. But in essence, by rebalancing consistently, you're buying low and selling high and taking the guessing game out of it. So those are two very easy strategies connected to the fundamentals. Go ahead, next slide, that I think everyone can do with the advice of your financial planner and CPA. Probably the biggest question I'm getting right now is, how do I know it's an opportunity. I get that. I've got cash, some cases significant amount of cash on the sidelines. How do I put it to work? Where and when should I deploy it? Now, the first point I want to make here is that this isn't your cash reserve. So remember, your cash reserve is your emergency fund, and typically, general rule of thumb there is 3 to 6 months of expenses. It might need to be more right now, especially if you're a small business owner. So we're talking about an amount that's above that. Again, my advice here would be take the guessing game out of it. You will never time the market effectively. Like, just know that, because you got to get two things right. Not only when to get out, but when to get back in. And so it's impossible trying to do that, especially now. No one has any idea about the virus and demand. Take the guessing game out of it. Consider dollar cost averaging. If you have $1 million on the sidelines, put a plan together. Immediately put for example, $250,000 in a diversified strategy, and then maybe monthly or quarterly, no matter what's happening, it goes into the market. My next point there would be to buy the market. It's something that I would recommend before you start trying to become a stock market expert. The market's on sale. So why not simply look at an index fund as an example, Vanguard Total Market Index that buys the entire market. It's very cheap, very tax efficient, and you know you're diversified. You could also do something related to different sectors, small cap, but what I'm trying to get at is you know, don't just try to become a genius all of a sudden and say, hey, I like these 3 companies. That is really closer to gambling than investing. Pay attention to taxes. If it's an after-tax account and you start buying individual companies and then selling, you're going to create taxable gains, and that can really work against you depending on how quickly you sell it. It's why if it's after tax, I'd recommend you look at indexing because they're tax efficient. If you are going to buy individual names, which is okay, or you do it with a portion of your funds, be careful. I never ever recommended buying something that was under $5 a share. To me, that's speculating. Pay attention to balance sheets. This is very important right now, especially if you're in the sector of hospitality or energy. Think about companies that are well positioned with a virtual presence. Clearly, things are going to change. They have dramatically, and it's likely that we don't go immediately back or ever back to the way it was. And one thing I like to do is think back, which helps me in future investment opportunities. Go back in time 6 to 8 weeks. What would you have bought then? And so I got some of these right, but I didn't think about some of them. And so what I'm talking about now is what we're on right now, Zoom. Look at Zoom's stock price and how well it's done. Netflix, obviously, Domino's, DocuSign, telemedicine, you know, larger companies that have that virtual presence, of course, Amazon, Walmart. You know, these are the types of companies I'm talking about. And then when you look forward again, you know, what might change, what opportunities might come to the forefront. I got this question before about asset classes. And so what I'm talking about there is asset classes related to equities or even bonds. So it'd be large companies, middle-sized companies, small companies, international. Again, I think the key here is to be diversified. Historically, coming out of a recession, small companies have led. They've also been beaten down more. I like that, but know that that may not be the case in this recession because smaller companies are riskier and they may not have the cash flow to get out of this. We shall see. Just also know that large cap and growth over the last 5 years has absolutely been the leader domestically in the US. Doesn't mean that's going to continue. If you look at the late 90s, for example, international was the place to be. By far, it's all I heard about back then, emerging markets, and that has really trailed. There will be rotation. The US is not always going to lead. Again, trying to predict that, I think, is fool's gold. So my last point on this is no matter what, stay diversified. You're building wealth, not speculating. And another great quote that I used to talk to clients all the time was you're never going to make a killing if you're truly diversified, but most importantly, you're never going to get killed. So next slide. Don't swing for the fences unless you understand what portion you're putting at risk. So let's talk about real estate. When it comes to real estate, I think the thing to be aware of is what sector are we talking about? Clearly, hospitality in particular and retail to some extent have been hit very hard. I think I read something the other day that hotels were still 10% occupied. Clearly, no one's going to be making any money. There will be bankruptcies for a lot of mom and pops in that arena. But that does present a unique opportunity, especially if you could predict when confidence comes back. Residential and multifamily, which is basically apartments, that's the space I'm in now as an investment firm. They have done really well, and to the surprise of many. But you know, with the stimulus package and unemployment, that's insulated those sectors in a really good way. My general thesis on multifamily is that people will always need a place to live, so it cannot be disrupted from a technological standpoint, and it's done well historically in recessions because people will start to downsize. So if you think through that, I think it's a great investment. Remember that scale matters when it comes to real estate. And what I mean by that is that if you've got a single family home or even a duplex and someone isn't paying rent or it's vacant for 2 months, you're immediately in the red. But if you have a 100-unit apartment complex or you are investing passively there, you could have 5, 8, 10% vacancy and it would still cash flow and be a very good investment. So pay attention to cash flow and location and property management where you're investing in. I do want to point out about REITs, which stand for Real Estate Investment Trusts or real estate funds. I think due diligence is appropriate there. What are they investing in and what do you actually own? Is it a piece of paper? Are you only investing in golf courses? You can see how that would be a very difficult investment right now. When it comes to syndications, which has become very popular over the last 5 to 10 years, whether that's in residential, multifamily, to me, it's all about who you're investing with. So the operator, even more so than perhaps the investment opportunity. When it comes to real estate, I'm a big fan because it offers a combination of advantages which no other investment can offer, period. Especially since the new tax laws that came out in 2017. So really, when you think about real estate, it can offer consistent cash flow, phenomenal leverage, especially now. If you look at where rates are to borrow money, it could be anywhere from 3 to 4% on long-term debt. It's really phenomenal. Certainly appreciation. One of the big things I like coming out of the wealth management world is it offers you control. And maybe most importantly is there are huge tax advantages. Just a quick aside on 2 of those. The first is that you can now take depreciation 100% in year 1, which offers some phenomenal tax strategy to offset income, depending on some various factors where you certainly want to include your CPA there. And then opportunity zones, which if you haven't heard much about that, is a phenomenal way to basically eradicate capital gains. And that is very new, but it's been out in the news in the last year or 2. Government's trying to spur economic growth, incentivize economic growth in particular areas. So I love real estate. I'm in it full time now. So you can probably tell I'm passionate about it. Just like anything, you certainly want to be aware of it and then also be aware of the risk. But also remember the downside to real estate, in my opinion, is liquidity. It typically is not going to be liquid like the stock market. So next slide. Certainly want to talk about energy and oil. I know a lot of people on the call are in different parts of the country, but a lot of Texas folks and Houston folks. In my opinion, this is not the time to speculate. There's just too much uncertainty. I know last month we saw things that never occurred ever before when it came to contracts and demand, things I didn't even know were possible as far as how it could go negative. So I'm not a fan of speculating on futures contracts or some of the new popular leveraged ETFs. And if you're not familiar with an ETF, that stands for, an exchange traded fund. And so they have these new exchange traded funds. They've been around for a while, but they're connected to a specific index. And in this case, it would be the price of oil or crude oil. That goes up 2 or 3x or down 2 or 3x the index that it follows. This is complete gambling, especially because it doesn't actually do that. It's based on a hedge and there's all sorts of complicated advanced things that happen with them. So I would steer everyone away from that. What I do like is individual companies that will pay you to wait. And so what I mean by that is great companies that are in the energy sector in some form or fashion that have a phenomenal balance sheet, and are paying a great dividend for now. And these would be companies like Chevron, BP, Exxon, refiners maybe that are a little bit outside that space in a different way, like Marathon or Phillips 66. And when I say getting paid to wait, I mean they've got a dividend. Back when the market was at 18,000, it was 10, 11% alone. And so you could invest in a phenomenal company that you know is going to survive and be paid 8, 9, 10%. It's less now, but they're still in the 6% range perhaps. And just wait. And eventually we know demand's going to return. And then as an example, BP, Chevron, they initially got cut in half violently. And so you can see how great of an investment that might be as the stock price appreciates along with a great dividend. So I think the main point here is just be careful. I know I'm beating this horse to death, but when it comes to wealth building, especially for a lot of people on the call that have very successful businesses and some that are retired, swinging for the fences is not the strategy. I used to always tell clients, I'd rather you come back to me if you came to me initially with $1 million or $2 million in one company, and we immediately diversified and lowered your risk. I'd rather you come back to me and say, hey, Trevor, I wish we would have kept 50% of my net worth in this one company because look at what it's grown to, as opposed to, holy cow, whatever sob story you want to, mention, Enron or whatever, I've got to go back to work now. And the other point I'll make here, go ahead to the next slide. The other point I'll make here is for a lot of the business owners, remember, risk is critical. Your individual business, that's where you take your risk. That's where you're an expert. That's where the biggest return obviously is. So then being as risky with your other investments, I don't think is an ideal strategy. You want to balance that to truly be diversified. So the last thing that I want to end on, and Al touched on this, is to me, this is the biggest opportunity. If you walk away with anything, this is it. And that is the most powerful investment concept ever. Hopefully that title gets your attention. But what I'm referring to here is it's tax-free compounded wealth. Taxes are a massive enemy to building wealth. And so I'm going to talk about a number of things here. The first is, do you have a Roth IRA, right? A lot of people on the call may immediately say, no, I make too much money, I can't do that. The answer there is that wait, because there's many different ways that we can get money into a tax-free position. So if the answer is no, the question should be immediately, why not? And how can we figure out a way to get you one and your family? Because if you just think about this, an investment that goes in after tax, okay, you got to pay taxes today, whether that's a direct contribution, your 401k, an IRA, Roth IRA, or a conversion, and it is never taxed again. Earnings, interest, and principal in compounds for whatever, 20, 50, 100 years, if we're talking multi-generational wealth, is a massive deal. So first thing that came to mind for business owners is, are you paying your kids? That's a fairly, well-known strategy. But if you're not, especially if they're under 18, we need to. It's a tax benefit for the business owner, right? Because if they're under 18, Social Security, Medicare, federal unemployment doesn't apply. I think it's up to $12,000 that you can pay them. You may check with a CPA on that. And then what I would do is I would take that $12,000 and start a Roth IRA for them. And what I did personally is I started a Roth IRA. I've got a 5-year-old and a 2-year-old. I took the other and put it into a 529, which is an education vehicle, which is tax-free as well, which has become even more valuable now recently with the tax law changes, because you can use the 529 not just for college, but for secondary education. And I would do that each and every year for each child. Now, just quick aside, I did some math. If you were to start saving $6,000 a year for your kids, and you did that, let's say for the next 20 years, and then they took over and started doing it, I know that is a big assumption, especially for young kids. But if you did that for for the first 20 years, and then they took it over, so it was a total of 50 years, 6,000, that's the maximum contribution. 50 years at 8%, that is over 3.4 million compounded that would be in a tax-free position. Phenomenal. Let's talk about Roth conversion. This is a little bit more of an advanced strategy, but used to implement this with my clients all the time. So number one, let's think through this. Most people, not everyone, but most people will have a lower taxable income in 2020, especially if you're a business owner, for obvious reasons related to COVID-19. So that means you might be in a lower taxable bracket. That's point one. Point two, the market is still down 20% and going lower as we speak. It looks like volatility has returned. So that is a great data point. You would rather have growth in a tax-free position as it recovers, compounded, than say a taxable position like a traditional IRA. So what I'm getting at here is, with your CPA's advice, you may consider converting money from a traditional pre-tax position like an IRA to a Roth conversion. Yes, you're going to have to pay taxes today, but for those reasons, it may make a lot of sense. Moreover, let's think about the big picture when it comes to taxes. Right now, we're in a very favorable tax position. The brackets are lower. We don't know what's going to happen politically. We also can clearly see that the deficit that we are currently in is expanding at exponential levels. So where do we think taxes are going to be eventually? Most people would speculate probably higher. And then also don't forget, historically, that it wasn't that long ago, like in Reagan's administration, where the top tax bracket was 50%. So look, I'm not predicting that. I hope we never go back to that, but it may make a lot of sense to look at a conversion strategy here, especially when you start running numbers and knowing that the market's on sale. The other couple things, and then we can open it up to questions, is don't forget about old 401k assets. There might be some opportunity there to roll them over, which I would recommend anyways, to an individual retirement account for flexibility, ownership, and having the investment world open up to you. But then you could look at converting potentially there, and check, because you may have some after-tax assets already. A lot of people do, they don't know it in their 401k. And if you do there's a very unique strategy. We can reach out to the provider and see if we can just target those after-tax assets and roll those into a Roth IRA. And we would rather do that immediately, by the way, because if you keep them there, they're after-tax, they're growing over time. The growth is going to be taxable. So we'd rather have the growth in the Roth, again, never taxed ever again, as soon as possible. By the way, this is why you have experts. Formulating a coherent financial plan with a CFP, a certified financial planner, your CPA, legal counsel, exit advice. I mean, this is where the value comes in working with experts, because, you know, we think about these things all day, every day. Wrapping up here, there's certainly more advanced strategies in a Roth conversion that involve entities. I'm not going to go into the weeds there, but I'll refer to it. And I would just say the CPA or your tax attorney is very, very important, because if your taxable income is lower, you want to be aware of where the next bracket is before you just start converting money haphazardly and bumping yourself up into the top tax bracket again, as an example. So there's a method, if you will, on how you may approach it, not just this year, but over multiple years, because I can assure you, in doing financial planning and looking at models and everything for the last 16 years, don't forget about the power of having flexibility in retirement, meaning where are you drawing your money and income from? If it's all from a taxable position, you may pay more taxes in the future than what you're paying now, especially if taxes go back up. A lot of people miss that. They think, I'm going to save everything in pre-tax. I'm going to have a lower tax burden today. And because I'm going to be making less money in the future, I won't have as much taxes. So that's how I'm looking at it. Not always the case. And remember that there's something called required minimum distributions that are looming out there when you get past 70. And that's an absolute abject tax bomb disaster, meaning you could completely lose control of your tax bracket because you're being forced to take out certain amount of income each and every year. Because remember, those assets haven't been taxed. You've been saving in everything pre-tax. Uncle Sam says, hey, wait a minute, where are our tax dollars? And so they come up with a formula and a calculation, and you start, it's mandatory that you take those assets out each and every year, and it only gets worse every year you get older. So there's massive opportunity here. If I haven't conveyed that, please make sure that you're aware of it. That is exactly what I would be doing and advising. Moreover, don't forget about the tax benefits when it comes to real estate. It's something I'm utilizing myself in 2020. And one of the reasons I sold in 2019 and delayed proceeds to 2020 because of this exact opportunity and strategy. So thanks so much again for having me out. Before we open it up to questions, I'd encourage everybody, if you want more information, go to my website at shakibacapital.com. Pretty much every TV segment I've done on Channel 2 is on there now. And we tackle all sorts of concepts and strategies. I'm also going to be doing some stuff with YouTube and putting that up. And if you're interested in a new way to invest with real estate, with multifamily that can check off some different boxes and really further diversify yourself from a traditional stock market investment, please reach out. Markets have kind of been frozen, but we think we're going to have some really good opportunities here in the near future. So with that, I'll stop talking and open it back up.
Thanks so much, Trevor. Everyone, we've got a few questions in the chat already, and we had some submitted to us beforehand, so I'm going to go through them. Feel free to keep adding them into the chat. You can do it either privately to me or to the group as a whole. So Trevor, our first question is, can you create a Roth IRA or Roth account for your kids? I believe you can, but can you elaborate on that?
Yeah, the answer there is absolutely, if they have income. So that's kind of what I was getting at is that if with the help of a CPA, you can put them on your payroll, and there's some qualifications on they've got to be doing something legitimate and the pay has to be reasonable and that whole deal. But look, if you go to my website, you'll see pictures of my 5-year-old and 2-year-old, and they're helping with advertising or whatever our CPA said. So you absolutely can. And it's just a matter of getting the right counsel, the right advice there to do that. And I would. It's a brilliant strategy. Checks off all the boxes as far as getting some apps, starting something for them. You can do it with education, the 529, and it's a benefit to the business owner.
Great, good to know. Still on the topic of Roth, if you already have a Roth 401k, does it make sense for you to have a Roth IRA as well?
I mean, to me, the more that you can get in a tax-free position, the better. So I think the question would be is what is that person's income? Because if you make over a certain amount, I'm going to guess here, I think it's around 160, 170,000. You will not be able, adjusted gross income, you will not be able to contribute directly to a Roth IRA. They phase you out eventually. So one of the great things about a Roth 401k is there is no income limitations to the Roth 401k. You make $1 million, you could save in the full amount after tax. If you're 50 or older, you get the catch-up contribution. And so, but if your income's under that, do the Roth. Maybe you do some pre-tax to get the tax benefit today. You do some Roth 401k and you still do the Roth IRA. One strategy we used to use a lot, this may be getting a little bit too detailed, but for a lot of our energy executives, we would max fund their 401k, also save in after tax, and every year we would go in through an in-service distribution, grab the after-tax dollars, roll that to a Roth IRA, and have them continue to max fund the regular 401k or Roth, depending on their situation. So that's going to depend, though, on who your provider is. If you're a small business owner, you could set it up however you want. I mean, there's a lot of flexibility. It's one of the great benefits of being a small business owner, not only the tax advantages, but the investment advantages. You can set up all sorts of different things, 401ks and pension plans. And again, that's where, exit advisors, CPAs would really be great advisors there.
Great. Actually, on that topic, we had a question submitted earlier about specific to small businesses and what strategies they can incorporate now. Maybe Al can touch on that one real quick.
Sure. Yeah, just to kind of add on to what Trevor says, as a small business owner, you have a lot of unique advantages that you can do. A big disadvantage that you have is that for most small business owners, the bulk of their net worth is tied up in their business, and it's an illiquid asset. So we've come off of a time of low interest rates, kind of high small business valuation, free-flowing capital in the markets, and it's tough right now. So again, small business valuations are down, some substantially. So what are some things that you can do right now? One thing that you can do is look at a family limited partnership. If you want to transfer some shares to your heirs, now is a real good time to do it. The lifetime exemption, I think it's $11.5 million. In my lifetime, it's been as low as $650,000 with, I believe it was close to a 50% tax rate. So we think that's an area that's going to get hit. So if you're thinking about transferring shares to your heirs, equity compensation for your employees, a lot of business owners don't know that when they transfer or they provide equity compensation, it has to be valued and taxes have to be paid on it at that point. So now is a good point in time as well. I actually have been working yesterday on a strategy with a couple of my former students. They're looking to acquire a small business. If you're a small business owner now, you say now may not be the time to sell, but I need to take money off the table, right? So how do I do that? One way is a partial sale, a management buyout, sell some shares to managers, sell some shares to a young, every year I teach about 350 MBAs that come through Rice. A lot of them are looking to acquire or get in to entrepreneurship. So it's entrepreneurship through acquisition. So we're working with a couple students to come in and take over partial ownership, give the owner a liquidity event, but keep them in the game so they can grow the business and he can have a second bite at the apple and sell the remaining shares down the road. So like Trevor said, a lot of strategies if you're a small business owner. Reach out to your CPA, reach out to Trevor, you can reach out to exit advisors, and we can help you navigate those waters.
Great. Let's see, we've got another question from Mark. So obviously the recovery is a big unknown, as you've highlighted. And that said, what is your view on the market and the recovery? Do you see it more V-shaped, U-shaped? Is it prolonged? Is it going to be a multi-year recession? You touched on it earlier, but maybe we can dive into that a little more.
Yeah, so I think you have to separate two things, the economy and the market. Remember, the market is it's a discounting mechanism. It looks forward, and it's the reason why the Dow, in my opinion, I think it bottomed at 18. I could be wrong. I think there's going to be continued volatility in the market, just like today in the last couple of days, right? But the reason the market bottomed and is already substantially 20% recovered is because it's looking forward. And remember, uncertainty, the market hates nothing more than uncertainty. And man, did we have uncertainty and fear February 10th, 11th, 12th, like unprecedented. Now, as far as the economy, like everybody's got their opinion out there. I think I initially thought it was going to be a V-shaped. I don't know. I can tell you in Houston, there's people out and about, and I mean, like people are ready. In fact, where I live, I've never seen more people out here on Clear Lake in boats ever. So, but again, if you look at California, Oregon, I just don't know. So my guess is that it's going to take time from an economic perspective to see more of a U-shaped recovery, especially with energy, hospitality, travel. With that being said, I think we're going to see some unbelievable numbers in the second quarter, 15, 20. I've even seen a prediction for 30% negative GDP. But with that being said, I've seen third and fourth quarter numbers of 15 to 20% GDP. So I think my answer is I don't know, nor does anyone else. I mean, what if we found therapeutic drugs that really worked and took a lot of the risk off the table? I mean, probably not likely to see a vaccine this early. But the more we know, more certainty returns. And I know there's a massive amount of pent-up demand.
Trevor, I'd like to add something to that about that uncertainty. I've never in my lifetime ever seen as much uncertainty, unpredictability. Last week I was in a board meeting, some of the smartest people I've ever been associated with. And on one side of the discussion was how do we handle deflation, right? People are going to sit on and not spend money. And on the other hand, well, we've pumped all this money in the economy. We're going to have this incredible hyperinflation, right? I've never been at a point where we've had a conversation from deflation to hyperinflation from brilliant people. I mean, some of the smartest people that I know, because the uncertainty is so much, right? I mean, same with the pandemic, from we're going to have this relapse to we're going to go back out there and we're going to have the sharp recovery and we're going to have a vaccine. So right now, there's so much uncertainty. And like Trevor said, uncertainty is what drives value down because you don't see it. We certainly think it's below because of the fear is built into it, right? That we're fundamentally lower than the fundamental value should be. But there's a lot of uncertainty right now out there in the marketplace.
But the one thing I'll say there is, remember, you've got to get to a point where you can you've got to put money to work. If going back to one of my points, if you wait till certainty returns, you will have missed it.
Trevor, yeah, I mean, it's short term, right? Short term. We're going to recover, and long term, right? What's ever purchased in this, valuations are depressed right now, right? In the short term, and we're going to see a long term recovery. When it happens, exactly when it happens, is it U-shaped, V-shaped? We don't know for sure, but long term, absolutely, right?
Yeah.
As we come out of this.
Exactly. And the other point I'd make there is, I used to tell clients this, is that in the midst of this, I mean, it is difficult, especially when you're seeing swings of, 5% in a day, right? But when you look back on this, think about how you look back on 08, 09. You look back on this in 5 years, 8, 10, 12, 15, whatever it is, it will be a blip on the radar, literally. And you'll say stuff like, man, what an opportunity. I wish I would have done X. And so that's what we're talking about now. And that's why, surrounding yourself with, good advisors can help you. But look, I get it. Emotion it is very difficult sometimes to be able to do that.
On the subject of volatility, and you mentioned dollar cost averaging quite a bit, is there a strategy for, timing and intervals when you're dollar cost averaging your portfolio, or do you base it off of valuation movements, or do you do a combination of both?
Yeah, I mean, here's what I did personally. When I felt fear and panic, I just literally took a chunk of money and bought the market. And I said, you know what, at Dow 18 or 19,000, this may not be the bottom. We may go another 20% down. But I know this, 10 years from now, just like when you look back in March of 09, it's almost mind-boggling to think that Dow got down to 6,600 in March of 09, right? And so we either believe in long-term that things are getting better, that they will get better through technology, medical advances, 3D printing, cloud, I mean, all the stuff I could, rattle off, or we don't. And so what I like to do is I've got dry powder. I'm going to make a move. And if it would have gone down from there, I would have continued to add and dollar cost average. So I think, like, look at it right now. The Dow is at whatever, 23,000. It was at 29.5, and I keep using the Dow. That's just what everyone's familiar with. The S&P 500 is really a better measurement for the total U.S. market. But we know historically the market is going to stabilize and recover. There's never been a time historically where that didn't happen. But trying to, invest everything at the right time, you just have to know that's not going to happen. And so, like, again, if it was me, if I had $1 million, I would probably invest 50% now, if you haven't. And then I would strategically, or every month or every quarter, say, look, moving forward, this is what I'm going to do. Everybody's got a different comfort level and risk tolerance, but that's how I would approach it.
Thank you. We got another question here in the chat, kind of relating to taxes again. Do you think it's better to pay the taxes now or after retirement if your income or withdrawal is lower after retirement than your income is today?
So what I would say there is there's quite a bit of assumptions, and I can't answer that question definitively unless you told me what the tax bracket was going to be at retirement. For me, I'm going to convert everything, just because I think that it's likely that taxes are going to be higher, and I hope that I do a great job in my investments in building wealth. So I don't want to have significant wealth in a taxable position, and I want to have the flexibility in the future to be able to draw from a Roth or wherever, and it's not going to be taxable or a taxable distribution. Moreover, at this point, I want to think about generational wealth too. So I'm a huge proponent. There's a book out there. I can't think of it off the top of my head. I'll include it in the notes or the follow-up email. It's by Ed Slott. If you want to get real into this, that talks about how there is a time bomb that's going to go off for a lot of people that don't know about it because they've just been saving in pre-tax forever. And eventually that taxable bomb, if you will, is going to go off when they get in their 70s.
Yeah. I'd just like to add something there too. If you're a small business owner and this is a bad year, you're not going to show a lot of profit, or your income's low, this is a really good time to do it. It's we're kind of having a perfect storm hitting in that regard with lower valuations, maybe income's down, taxes are down. So certainly consider it.
Trevor, are there any investments that you would avoid right now, just avidly stay away from?
Yes. Anything that's under $5 a share. That's number one. I don't know why everyone's drawn to that. Like, to me, it's gambling. If it's under $5 a share, there's a reason. There's a very good chance that it's not going to make it, right? I mean, so that would be number one. And I would be very leery about anything in the hospitality space. We just don't know who's going to make it. I mean, are you comfortable getting on an airplane right now and staying at a Marriott? Warren Buffett just came out and said he sold all of his airline stocks or something to that effect. So just be careful in that space. Again, I would go back. If your net worth is $5 million and you want to put 100,000 to some of these speculative plays and know you may completely lose it all, then understand the risk. Marriott, Hilton, airlines, Boeing. I mean, you just have to know you may hit it out of the park there, but at the same time, there's going to be some carnage, some bankruptcy, and some very difficult things in those spaces.
Great. Well, we're creeping up on the hour here. I think I've got one or two more that were submitted. Maybe we can get to those, but if anyone wants to throw any last minute questions into the chat, please feel free to do so now. Trevor, you were going a little bit into REITs earlier. Could you elaborate about some of those investments, ones that you would be more attracted to versus others? Which types of real estate investments you would like to move into?
Sure. Well, and remember, a REIT is a real estate investment trust. It's like a mutual fund kind of private. You're pooling investors' money together, and then a management team is going to invest that. There's all different types of REITs. And, you know, if you're investing in golf courses, hospitality, office space, I think you just need to be real careful there. I mean, how confident is everybody that office space is going to just go right back to normal after this? I'm not. What I am a big fan of, I keep harping on this, and this is, you know, why we moved into this area, is I really like housing and multifamily in particular. So that would be something I'd look at. Personally, I wouldn't invest in a REIT because I don't know that, you own a piece of paper there. I like owning real estate, like the real asset. And I think that it can be done. Moreover, the tax advantages there are going to be much more substantial than owning a real estate mutual fund, ETF, or REIT.
I think a good closing question would be maybe on the types of mutual funds. Is there a good way for people to vet these index products? You know, which ones are going to be better than others?
Yeah. So, you know, I mean, this may be beyond this call, but, you know, when you talk mutual funds, you're talking about active management, and in theory, this manager and this team is going to add value in whatever they're doing above and beyond what the index is doing. And then an index fund or an ETF is passive. So you're basically buying the market. If it's a large cap, I wouldn't invest in any active management personally, because most people don't outperform the market. So why not look at Vanguard or iShares that has an expense ratio of something like 0.03%? And you're literally just owning the 500 companies, the largest 500 companies that make up the S&P 500. Excellent way to invest, especially when the market's volatile and down, right? You're just going to own the 500 biggest companies. I'm owning the market. Now, when you get into small cap, emerging markets, you know, if you want to invest in India or Brazil, I mean, I don't know why you'd want to get that specific, but that's where a great manager is going to add significant value and probably worth maybe the cost to do that. Also pay very close attention to taxes. If you own a mutual fund that's active and it's after tax and they're buying and selling, those taxable gains will pass through to you. And then some years you'll be like, holy cow, why am I paying 15 or 20% on this gain? And then everybody gets upset. Well, that's why. So if you're going to do active management, you may consider doing that more in your Roth and traditional IRA, which are tax deferred, as opposed to an after-tax account where I would just basically be very tax efficient. And again, remember to be diversified. So just owning the S&P 500 index is just a large cap. So you may want to have other indices that represent middle-sized companies, small, international, etc.
Well, perfect. Trevor, thank you so much for your time today. We got a lot of great questions answered, a lot of insight, and thanks to everyone for joining us and for sharing those questions with us. We will, as always, send out this presentation and the recorded version of the presentation in an email to follow up. But if you have interim questions in the meantime, for either exit advisors or for Trevor, please, you've got our contact information. Reach out to us anytime. We're here to help.
Thank you, Trevor.
Awesome. Thank you, everyone. Appreciate it.
Have a good day.